Hi, it's Phil at Stopford's. Today I want to talk a little bit about deferred tax. Another one of it is frequently asked. Whenever I tend to deliver a set of accounts or present a set of accounts to a client, deferred tax always comes up. I've been explaining this for 36 years. I think I've got the knack of it. But I'm trying to explain it to you as simple as I can. Okay. What is it? It's a tax. Do you pay it? Where does it go? Okay, so yeah, it's a tax, but no, you don't pay it. Okay, and it only applies to companies. Two main ways that deferred tax arises. Okay, so this company bought a big asset, piece of machinery, £100,000. So there's a big difference between the way that it's treated in the company's accounts and the way that HMRC allow us to treat it, because we get capital allowances and that asset is effectively written off for tax purposes in the year that you bought it. So in this example, we're depreciating it over 5 years. So at the end of year one, there's £80,000 value left in the accounts. But in corporation tax, there is zero, because it's all been written off. It's all gone. We've had tax relief for it. So there's £80,000 difference between the way it's treated in the accounts and the way it's treated on the tax computation. So we have to apply this extortionate tax rate of 25%, which is the current rate, to that £80,000. So the deferred tax on that is £20,000. So ordinarily, if it wasn't for those capital allowances that we've got in that year, the corporation tax would have been £20,000 higher. So we have to make allowance for that £20,000 in the accounts. Again, it's not a tax that you pay, but we have to make allowance for it. Okay. Second way it tends to arise is with revalued property. So same amount, 100,000, but this time you bought a property, but it now happens to be worth £150,000. So we effectively got a profit, if you like, of £50,000. We haven't got that profit in the bank because we've not sold it. We're just revaluing it. But we've got a notional profit of 50,000, so we have to apply again tax to that. So at the current rate, which is 25%, £12,500. So we've got deferred tax of £12,500. So we're in your accounts, the company's accounts, we're increasing the value of the building for £50,000. So it's a profit. You've not got it. It's what we call an unrealised profit that will sit in a reserve until the property is actually sold. But we've done that, so we've got to do that. So we've got deferred tax of £12,500. Okay. Is it a tax? Do you pay it? No. It's an accounting transaction. It's a paper transaction that only happens in your accounts. Where does it go? Okay. This is company balance sheet. Up here in creditors, amounts fallen and due within 1 year. This is where normal corporation tax goes, along with VAT, PAYE and everything else. Deferred tax sits down here, where is what we call provisions for liabilities. Because it's not due, we've not got to pay it, so it's just a provision. We're just making an allowance for it, so it sits in a different place. It sits down there on your balance sheet. But as they say, every debit has a credit, so if it's going on a credit in your balance sheet, it is also a charge in the company's profit and loss account, so it will be included in tax on profit for that year. So the company's corporation charge for that year is normal corporation tax, £1,250, and the deferred tax of £20,000, £21,250. Okay, hope I got that across. It can get more complex because it does change over year 2 to year 3 as the value of that asset decreases, but that's basically how it arises. And yeah, as I say, Go and do something more interesting. All right, thank you.